Hey everybody, welcome back to this Bradley video, part 4 on the Bradley Barometer. And we're going to look at some of these charts from the 40s, which was the time when Donald Bradley was actually working on this information, into 70s. And then we're going to look at the stock crash of 1987, because that's really the big one that people talk about as being really a historic market crash in modern times. So let's begin here with our chart here at 1946. So we did have a substantial decline in 46 here. This is slightly after World War II. Looking at this chart here, you can see that again, we have the blue line here with the Bradley Barometer, followed by the black line, which is the Dow Jones Industrial Average. So you can see here that the Dow Jones Industrial Average makes a steady climb here in 1945 after the war, and then to 46. And then we start to hit a peak here somewhere between May to June of 1946. And then we start to see a substantial decline here in the market, going all the way down here into this October, November, December area. And then we start to see kind of a choppy recovery into here, a double bottom forming into here, and then again another rally up here. So let's see how the Bradley Barometer did with this, and I'll kind of walk you through this again. So the Bradley picks this up here on this initial ascent. Bradley does dive here, and the market does diverge a little bit more against it, but the overall thrust of the Bradley was to the upside here, and I think that's the main takeaway of this, that we should be looking at that overall thrust of the Bradley. Overall thrust of the Bradley there. So overall thrust of the Bradley was, like I said, pushing to the downside after it hits this peak into here. Here's the peak of the Bradley here, and it comes pretty close to the actual peak of the Dow here. So this is occurring here somewhere here into early June into here. And then you can see here, that's the actual top. This one actually does pick it pretty well. And the reason that I picked this example again is because this was a pretty severe decline in the Dow Jones. And it was a swift decline. So we want to look for emotional moments like this. When we have a very, very sharp decline, we want to see if the Bradley's able to pick up that emotion with a very, very sharp decline. In addition to the regular moves, but we want to make sure that when we have these severe declines, that we can see this, and you can see the Bradley does pick this up. The Bradley does hit a bottom here and does start to do a slow and steady climb into here, and then the market does have that choppiness into there, but it does try to rise up into here, and then it just continues that choppy move. So again, the Bradley does diverge a little bit up above while the market goes below here, but the main meat of the move here, if you're talking about the main peak here in this June period all the way down to this October period into here, this did occur during a big descent of the Bradley. So the Bradley does catch another emotional move here in 1945. And I'm just picking different decades to show that it doesn't really matter when you do this. We did a lunar study on this too on the markets, and it didn't matter when you picked the lunar cycles. They kind of occurred consistently across time. And if you sliced it any month that you sliced it, it was pretty consistent. So that was interesting too. Now, this is 1973, 1974, 1975. There was an important low formed here in 1975 on the market. So you can see here, the market here is this 1973, 1974, 1975, 1976, 1977. And you can see the Dow Jones was making this steady decline here into this eventual low here into this late 1974, early 1975 period. And then the Dow Jones does make this rebound rally, very sharp rebound rally here into 75, 76, 77. And so the Bradley does an excellent job again of basically picking this out. Bradley did have a decline here initially, and then it rebounds all the way up here. And so it was a little bit late here in forecasting this one, but generally, if you look at it missed a few months into here. But generally, you can see that the decline of the Bradley here was correlating very, very well with the decline of the market. And so, once again, on this latest decline here, once you start to see the market in a very, very sharp downward phase, we would expect to see that a turn on the Bradley lower at that point should coincide with a sharper move. So here's your turn on the Bradley right here. And so you can see that this does in fact coincide with a very, very sharp move at the very, very end here. Bradley continues to go down here, very, very close to the low here. I mean, there was a double bottom into here, but the final low, the Bradley actually did a very good job into here picking that. So once again, the Bradley does a good job here of picking at least one side. Like this was a little bit late into here, but it did pick this. And then the interesting thing was there was this V-shaped rebound in the Bradley, and the market does recover with it here. And you can see the Bradley continues to kind of meander higher into here, and the market also continues to go higher into there. And then once the Bradley makes its final high into here in 1976, you can see the Bradley starts to really have that sharper decline, and the market does do more of a gentle rolling over type of a pattern. So certainly this didn't have the intensity of 1929 or 1987, but just goes to show you here still too that the general mood, the general meandering of the transits was affecting the market patterns here in the 1970s. Okay, so now let's ask another question here. We asked this before, but how does the Bradley do in the really, really big market downturn? So we already looked at the stock market crash of 1929. What I want to do now is look at, and we looked at some other declines here in the, like I said, in the 40s and in the 70s, but really the 87 is the one that people really think about when they think about stock market declines. So this market crash is very, very interesting because from an astrological standpoint, you can study this from many different perspectives. For example, this particular market decline, and I'm not talking about the Bradley right here, but this particular market decline occurs on a Mercury station. Okay, so Mercury retrograde station. So this occurs on a retrograde. So the planets were slow. Planetary speed index, which is another one we looked at, was slowing down and decreasing. You had a stellium here, which was all the planets building into a peak. So this particular crash was unique because no matter, you could look at this from many different angles astrologically, but there's this big stellium forming here, which is basically when a bunch of planets get together in the sky. So for example, if you have the sun, you have Venus, you have, sorry, Mercury, you have Venus, Jupiter, they could all be lined up into this really, really tight orb, and that tends to draw markets up. And then of course you have the Bradley here, which we're looking at here. And then the fifth one, you had Venus, Uranus aspects. And so those occur around market crashes. So anyone who follows this stuff knows that anytime you have Venus, Uranus interacting, Venus is closely related to money and markets. And so this planet is very, very sensitive, and Uranus is sudden unexpected events. So when this occurs, this is all occurring like out into here, but all of these other things that we look at were also occurring, and then the transits, which is the Bradley, was also turning lower. So this particular crash checked all of the boxes for what we would want to see for an ideal crash situation, at least in the past. And then of course we had our October pattern into there too. So that was a seasonal pattern. So I would throw this the other one here, the seasonal pattern, and that's also a solar cycle, which we can address later. But the seasonal pattern is basically what is it doing at each part of the month, each part of the year. So, you know, you have this October decline, you have the Santa Claus rally, you have the sell in May and go away, all these different phrases that people make about the market. It's a seasonal pattern, but really it's just a solar cycle. So if you say seasonal pattern to people, they say, oh, I understand that. But if you say solar cycle, they're like, what? What's that? What? So I just wanted to point out this particular crash, this 1987, was unique, and it was very, very special. So we are just going to be focusing though on the Bradley right here. So, you know, you can look at this from a financial astrology perspective. You can look at this particular crash in many different ways. And I've done presentations on this before on all these other aspects, which are signatures of crashes. I called it market crash signatures. But the Bradley in of itself, you can see here that this was climbing and climbing and climbing here. And this climbs essentially from 1987 into this January period into here. It starts it's a long ascent into here all the way up, and the markets were drawn into this stellium. So we had a big stellium in the sky here, and the markets generally were just continuing to be drawn up by this. The thing about stelliums is that when you have a stellium, what you end up getting in stelliums is you get like a fading effect because it takes a while for the planets to break up. So you had this high into here, and the stellium starts to break up and it starts to kind of drift down. It didn't look like it was doing that much, but you can see here that the Bradley was declining, and we were getting this Mercury station into here. We were getting all of these really, really hot signals into here that we look for a crash, and the Bradley was declining during this crash, and of course the market does crash across the Bradley. But again, the point is that we can look at other ways to describe a market crash from a financial astrology standpoint. But this video is about the Bradley. And the fact that the Bradley was still working even back in 1980, up to 1987, because the Fed was really, I mean, the Fed was a thing at this point because Alan Greenspan stepped in and says, you know, you have the full backing of the Federal Reserve of the United States, and there's all this argument about there was a mystery buyer, and was he in Chicago or New York, and they were printing these different prices, and depends who you talk to. If you talk to someone from Chicago, they're going to say that, oh, Chicago saved the market. If you talk to someone from New York, they're going to be like, no, New York saved the market. The bottom line is, whatever the case was, the Bradley forecasted this very, very well, and this ended up being a very, very short decline in an overall bull market. So you know, this was the actual bear phase. It just lasted like a couple of days. Like it can happen that fast. So this was a very, very big decline, but the Bradley was declining during this period, and then of course the Bradley recovers here. You can see that it recovers and starts to just to kind of hook itself back up into here, and that was kind of the end of it. But again, once again, we see that the Bradley tracks emotion. And again, I'm trying to go to all of these market crashes so you can actually see that we're not just picking dates where, oh, look, the Bradley matched up on this date, let's show this chart. No, we're picking actual historical events where the market crashed. And so, you know, like again, this is the mood, the psychology of the people. The stellium was building up into here, and the Bradley was falling, so the transits were falling, and so this reflected in a very, very fast decline in the markets, but matching the Bradley and matching the mood of the planets as they were up in the sky, as the transits were making their specific aspects here. All right, guys, so that's all I got for this part on part 4 of the Bradley Barometer. I hope you enjoyed this video. Hope everyone has a great evening. Stay safe out there, and I will talk to you soon. Peace out.